before your examination, I think we started with our discussion on exposure monitoring. So things like what is a current credit exposure, what is a potential future exposure, etc. But I think we haven't discussed something on limits, right? I mean, we have already mentioned about limits, but how exactly limit monitoring happens, that is something which we haven't discussed, if I recollect. So am I right? I think we did not talk about treasury and trade limits, right? And the way in which those limits are monitored. So I think that is something which we will cover quickly. So just to give you an idea, because from a risk management perspective, having an idea of the limits framework is very useful. I'll just share my whiteboard. So when we talk of a limits framework, these are more of real-time limits. And the idea behind a limits framework or a limits module, which we purchase as a part of your Calypso or Murex or any other treasury system, the idea of the limits module is to ensure that whatever things are done on the portfolio, they remain within a certain threshold. Because if you recollect, in one of our earlier classes, we had spoken a bit about the various policies which are there in an organization. So one of them talked about the kind of risk tolerance, risk threshold, etc. So the limits are the idea to convert that into something which is a quantitative in nature. Because just saying that we are having a medium risk appetite is very, very confusing. It's very abstract. You won't understand what is a medium risk appetite. But if we can put a number to that medium risk appetite, that will make monitoring easy, because finally we want to have some way in which we can monitor stuff, and that monitoring can happen through a limits framework or a limits module. So you can imagine that there are limits which have been set for every or most of the activities which your business is going to do. So imagine that there is a let's say there is a front office, and within the front office, imagine there is a derivatives desk. So let's say, so there are other desks as well, but imagine that you have a derivatives desk. So you have a head, then you could have maybe a senior trader and maybe a junior trader. And maybe I'm talking about, and let's say I want to place a cap on the maximum deal size which a trader can hit at one point in time. So maybe I can call that as a single deal ticket or a single deal size limit. Let's say the single deal size for the head trader could be maybe INR 100 crores. I'm just putting arbitrary numbers. For a senior trader, it could be, let's say, INR 60 crores. Maybe for a junior trader, it could be INR 20 crores. Now, the idea is, now this is just one example of a limit. Now, this means that if head of trading decides to transact with a certain client tomorrow, then the maximum deal size which they can do in one shot is 100 crores. So every single transaction which they do cannot breach 100 crores. Now, there can be instances whereby this might have to be breached. So at that time, what happens, we'll see. But at the moment, just imagine that they cannot breach 100 crores. Similarly, senior trader has a limit of 60 and junior trader has a limit of 20 crores, which has been set. Now, the idea behind this is we are putting a cap on your trader behavior, because traders are from the business side. So they would always want to push for more business with the clients. But it's the responsibility of the risk management to ensure that, yes, some kind of risk has to be taken, because if you don't take risk, you cannot reap the returns. So, but that risk has to be kept in check. So one way to keep that in check is monitoring these limits, and these will be continuously monitored. So inside your limits module, so this is like a live module which runs inside your enterprise risk software. So be it Calypso, Murex, or any other popular treasury systems. And this module is going to track the activities which your trader does. So every time a trader is hitting a certain trade, this limit will be compared. And if there is a, so let's say head of trading wishes to trade with a client tomorrow, and let's say they want to enter a trade size of 110. Then before the trader actually hits the trade, there will be a pre-trade check which happens. So system will prompt that your limit is 100 crores and you're trying to push a trade for 110. So in that case, you are requested to take approvals from higher ups. So now head of trading is already a senior position. but there could be head of GMG. So on top of the head, you could have a head for the entire global markets group or the entire front office. So head of GMG will monitor everyone, derivatives, fixed income, equity, FX, etc. So maybe that approval could go to GMG. So head of derivatives might have to justify that why he or she wishes to breach that value of 100 crores and why they want to hit a trade of 110. And if head of GMG is convinced, they'll give a approval and the trade can pass through. But that's how your limits module functions. So this is just one example. You could have limits on various things. So you could have a limit on maybe the duration of your portfolio, or maybe on option Greeks, etc. Now, all of these things are something which are monitored on a real-time basis, so that if a breach has to happen, that will immediately be reported, and the trader may have to take a required corrective action. Or maybe, if the trader realizes that a breach is happening, the trader might want to modify the trade before he pushes that trade into the system. So this is the idea behind having a limits framework. So any questions on this?
Sir, how real time is the monitoring of the risk? Like at the end of day, is it presented to the trader?
No, so these limits are monitored continuously. So as I mentioned, if tomorrow head of trading wants to push a trade of 110 crores, then since I say that this is like a live tracking mechanism, then when the order is entered in the system will immediately prompt that your limit is 100 crores, but you're pushing 110. So do you still want to go ahead? If yes, you're requested to take permissions from higher ups and then push a transaction. Or if you don't want to do that, modify your trade, bring it up to 100 crores or below, and then push the transaction. So that way, the live tracking continuously happens.
Sir, was this enacted after 2008 crisis? 9.
Not really, actually, because this has been a part of risk management for quite some time now. Maybe after 2008, the number of limits which are being tracked might have gone up. So maybe more number of parameters might be tracked. But this is something which has been around for a while now. Of course, post 2008, even the systems have become more advanced. But the idea of limits monitoring has been around for some time.
Okay, sir. Thank you.
So this was a brief idea behind the concept of limits. Now introducing you to a couple of measures which we call as trade and a treasury limit. So now there are three entities which I will just mention here. We'll talk about these in a moment. So we have head of GMG. We have the head of FIG, which we call as the Financial Institutions Group. Uh, Other than this, I think these two should be fine. And let's say we take a certain customer. So let's say the client's name is X, and there are two limits which are, so when you say that there is a total limit which has been set, we divide these limits into two parts. One is what you call as a trade limit, and other is the treasury limit. I just erase the things on the right hand side. And then we simply add them up and we have the total. So I just put some arbitrary numbers now. So let's say the trade limit is, or maybe let me put a total limit as 100 or maybe 1,000. And let's say the trade limit has been set at 400, and let's say this has been set at 600. Okay. So within your limits, or within the limits which get approved for every customer, let's say that bank X or maybe customer X, you have a total limit which has been set at 1,000. So you can imagine any denomination, 1,000 crores, 1,000 million, that won't matter right now. So let's say 1,000 has been set as the limit on X, which is the total limit. And this has been split into two parts. One which we call as a trade limit, and other is the treasury limit. So how do you bifurcate between them? Treasury limit is something which will be tracked against every activity which your front office does. So whatever transactions your trading desk is doing, that will be monitored against treasury limits. Whereas trade limits are something from more from a credit lending perspective. So let's say you want to lend a certain amount of money to party X, then that thing will be governed by 400. That is, and anything which is of non-trading in nature will get captured as a part of your trade limit, because your trading thing is getting captured in the treasury side. Non-treasury stuff gets covered in the trade limit. And these two limits will be plugged into your system. So if you're a part of risk management, you'll have access to the limits module, whereby you'll create a new entry. Or so imagine that is a new counterparty whom you're transacting with. So you will create a new entry for party X, and you're going to enter 400 and 600 as the numbers for monitoring. So we can imagine that these are thresholds. So this is the maximum exposure which I can have to party X. So this is something which has come from my policy, so I have to follow that. Now, this bifurcation gets decided by someone whom we call as the FIG group, or the financial institutions group. So an FIG group is like an independent group away from GMG. Now FIG is in charge of the limits. So limits module, yes, it's operated by risk analytics, but how the limits are set and how exactly they'll be bifurcated, that is something which comes via the FIG. So FIG, you can imagine, are the owners of the limits framework which has been created. So FIG decides that based on the inputs from business and based on their view on the overall way in which the market is behaving, they would want to set these limits at 400 and 600. So let's say that agreement has happened. So this will happen for every counterparty. So let's say party A, B, C, D are there as well. You'll have limits which are set for each of them. So this is what you call a setting of limits. Now comes to the monitoring bit. Now, monitoring, as I mentioned, is something which will happen on a day-to-day or at a regular interval. So every time a transaction happens, your limits are going to be tracked. Now again, these are limits which have been defined, but they are not something which are engraved in stone. So it doesn't imply that you can never breach these limits. Now, limits are there to be breached at time, because if you find a good business opportunity, just because you don't have limit should not restrict you from pursuing that opportunity. So to take an example of that, let's say that that the treasury limit is currently at, let's say, 590 crores. Let's say this is my current consumption. So this is my consumption. And let's say this limit is currently 0 crores. So let's say no activity is happening on the trade limit side, but the treasury is immensely active for counterparty X. So at the moment, the exposure is standing at 590, which is very, very close to the threshold. Now, let's say the treasury team comes up with another strategy saying that we have one product which we want to sell to a party X, but that is going to push our exposures up by, we expect to be roughly close to 60 crores. So they say we require additional 60 crores here. This is the additional part. So roughly they say we expect our exposures to move up to 650 crores. Now naturally, if it's 650, it is going to breach this value of 600. So that is something which will show a limit breach. So at that time, what the trading office or what the front office can do is they can create a note giving the reasoning that we have such and such a transaction, giving the rationale that we want to trade this with party X because we feel that this can be a profitable transaction for the bank in the near future. So that's why we expect so we request a temporary increase in the limits. So this is where now this request is something which will go to FIG. Now this limit cannot go. Now this request cannot go to GMG because then it is a conflict of interest, isn't it? Because treasury limits are something uh, which are there to govern the action of people who are working in GMG or work. So GMG is also the front office. So if your traders request an increase in treasury limit and simply if GMG approves, that is incorrect. That's unfair. It's a conflict of interest. So if a certain limit has to be transferred, so now we know that a trade limit is zero. Its consumption is zero at the moment. You have entire 400 crores available. So the request for increase in limit will go to FIG. So FIG will then talk to trade team saying that there is this request which has come in from the front office, and they are requesting a temporary transfer of limit. So they will ask, firstly, do you expect a business of 400 crores or maybe 300 crores to happen with counterparty X, let's say over the next 1 month? So imagine that the treasury team is requesting additional 100 crores. So let's say they want to push the limit up by 100 crores, and they want to do this increase in limit for the next 1 month. So FIG is going to ask a question to the uh, the the, the trade limit guys, or maybe the credit guys, that do you expect that the lending is going to exceed 300 crores? Why 300? Because at the moment the limit is 400, but if 100 have to be transferred to treasury, then all that trade limit is left with will be 300 crores. So this is going to come downwards by 100 crores. So if trade says that we don't expect to breach 300 crores over the 1 month, then FIG says fine, then we can allow the temporary transfer of limit. So at that time, what happens is FIG is going to give a temporary approval to move 100 crores from trade to treasury. So now your revised framework would look something like this. This will come down to 300 and this will go up to 700. Your total still remains to be 1000. So this is how your temporary limits are transferred, and this will continue for 1 month. After 1 month, these will reverse back. So that way, 300 will move up to 400, and 700 comes down to 600, which are our original limits. So that way, whenever we expect any increase in business to happen, such kind of fungibility of limits is possible. Of course, with FIG's approval. Now, this is just from the treasury side. It may so happen that the trade limit is near threshold, and they expect some additional limit for a temporary period of time from treasury. So that is also something which can happen. Again, that request goes to FIG, or the financial institutions group. And such things always happen. So whenever there are good opportunities to be pursued, these kind of activities are something which are always done. So any questions on this? Okay. Now, again, as a part of risk management, it would be your job to keep track of these things. So, whenever, so let's say the request and approval comes from FIG, and if you are the one who is monitoring the limits module, it's your responsibility to reset these numbers to 300 and 700, and you need to keep a track. That is, after 1 month, this has to be reversed back to the original ones. That is, 300 should be reset to 400 and 700 to 600. Because if that doesn't happen, then that will imply that you're not using a correct limits number. You're using something which is temporary in nature. So either have an automated thing or maybe monitor your calendar so that after 1 month's time, you simply switch it back to the original numbers. Now, this was about fungibility of limits between trade and treasury. Now, many a times it can happen that this limit of 1000 itself has to be risen. Now, this is something which requires board approval, because now whenever you are actually increasing these kind of, so if not the board, at least the RMC, which I call as the risk management committee, I don't think board approval will be required, because limits are something which are more of a responsibility of the risk management committee. So risk management committee, if you recollect, is one of the committees of the board. So if you recollect, in I think our first or second class, we had spoken about the org structure for a bank. So we have the board of directors, the committees of the board, and then the MD, CEO, etc. So RMC is one of the committees of the board. And if this limit of 1000 itself has to be increased, so let's say business comes with a justification or with a rationale that we expect that a significant amount of business is going to increase with party X over the year. So we request this limit to increase from 1000 to 1500. So if such a request comes in, this has to go to the RMC for approval. And once they approve it, of course, RMC will be in sync with what FIG thinks as well, because they will be working closely. And finally, if approval comes, then this limit can be revised to 1500 crores. So that way, even your total limit can be increased. Now, there is a way in which your internal treasury limits can change as well, because let's focus on this treasury limit side, which is 600. Now, my treasury limit is currently at 600. Now, this 600 could be divided amongst various treasury desks. So, let's say I have a fixed income desk, I have an equity desk, and let's say I have a derivatives desk. And out of this 600, let's say fixed income has been allocated 400, equities have been allocated maybe 100, and derivatives 100. I'm just putting again hypothetical numbers. Now, let's say this is the current allocation. So now this allocation or this bifurcation amongst desks, this is something which is completely the prerogative of the head of GMG. So now this bifurcation is something which will be governed by GMG head's approval. That is because all the head of GMG is doing is it's still working on this 600 crores which have been allocated to them. How exactly they want to allocate 600 crores, that's completely their decision. So GMG has the full power to move these limits around these desks. So again, let's say that derivatives desk is transacting a lot with counterparty X, and this limit is close to, let's say, 95 crores, or let's say this is my consumption. So that way I just have a 5 crore gap which is there. Now, and imagine that the derivatives team says that we expect more derivative transactions with party X. So we expect an increase in limits. So head of GMG, so they go to head of GMG for approval with their rationale. GMG can approve. So what GMG will do is he or she is going to check what is the consumption for fixed income and equity desks. Whichever desk has additional room, that limit will get transferred to derivatives desk, albeit for a temporary time period, and then derivatives team can do that transaction. So that way, if we are to simply play around within the approved treasury limit, you can simply do it via head of GMG. However, if you want to move the limits between trade and treasury, you have to approach the FIG. And finally, if your total limit itself has to be increased, then this will require RMC approval. So, any questions on this? Okay. This is done. So I'm just reading from the slide if anything is pending, and then we can come back. Again, the role of CCPs is very, very important whenever it comes to exposure monitoring. So we have spoken a bit about CCPs in the past. Uh, when you talk of a CCP, imagine an exchange. Uh, so my question will be: can they default, or can a CCP never default? What do you think?
So can you repeat your question, please?
Yes, can CCPs default? That's my question.
So I missed the CCP's definition.
So central counterparty. So it could either be someone like an exchange, or maybe someone like CCI, or maybe someone like LCH, etc.
Sir, it has happened. Commodities, one of the commodities exchange, I think MCX or something, due to fraud or what, it did
Fraud
default.
is fine, yeah. Fraud is a different thing. But other than fraud, do you feel there is any probability or possibility that a CCP can default,
Sir,
or it can never happen?
sir, unless the mark to market is not paid, then it can default. It can escalate and cascade through the system. But that is a hypothetical scenario. But and it can be contained to an individual client. So it won't go like a domingo, but yes, they will take some damage.
Okay, okay. Any other views on CCPs defaulting, whether it's
Don't they
possible or
have
it's never possible?
don't they have guarantee fund something which is used in this
Correct,
case?
correct. Yes. Correct. So the idea is, so you're right. So I mean, CC. So the answer is yes, they can default. The probability of them defaulting is low. That is correct, because there are various checks and balances which CCPs use whenever they are doing clearing and settlement. Now, why this point is relevant from exposure monitoring? Because many banks are going to try and use the services of CCPs in order to reduce their exposures, because whenever you have any transaction which is done via a CCP, that is, whenever you have a CCP, someone like maybe an LCH, which is providing the clearing and settlement for your transactions, that means your credit risk has been taken care of. So that way, these kind of transactions get eliminated from your limits monitoring, because you know that there is a central counterparty and you don't expect the counterparty to default. So that way, the headache of monitoring the credit risk moves on to the CCP, and that frees up limits considerably. So that's why we see that there is a lot of push from the banks to move trades onto CCPs as much as possible. Because if I can move them onto a CCP, that particular trade is not going to attract any exposure calculations. And if there is no exposure calculation, my limits don't get consumed. So that allows me to do more business. Now, of course, now there are certain risk weights which we apply for transactions which we do with a CCP, but that's a different thing. But when I talk of counterparty limits monitoring, so someone like a party X, which we just mentioned. So if I and party X are able to leverage CCIL as a platform to transact on on our trades, then that brings down exposure considerably, and that will allow me to do more amount of trading with counterparty X. So that's the advantage of having trades move onto a CCP. And there are various ways in which CCPs can actually manage the credit risk. So, firstly, they are private institutions. So, they also don't have unlimited access to money. So, they are not a central bank. So, they can't really print money if required. But there are a few techniques or a few layers which they use in order to manage the credit risk. Now, again, having an idea of these things is important because there is an increasing trend of using central clearing as much as possible. Now, bilateral clearing and settlement is always there because in the OTC markets, that is by far the most popular way of doing things. But if we are working on a standardized contract, maybe something like a standardized IRS or maybe even a standardized single name CDS contract, now these things can be pushed onto a CCP. Now remember that CCPs are not going to clear every transaction. They don't do that. They do that only for standardized ones, the ones which I mentioned. So imagine that the volume of such transactions is high on my book. Then I can leverage the CCPs in order to reduce my overall exposures. And that way I'm able to free up my limits so that I'm able to pursue other business opportunities with counterparties. So, few ways in which CCPs are going to protect themselves and their clients against default. One is the idea of initial margin. We have a variation margin. Then we have a default fund contribution. We have a members equity. So the model for a CCP is, so imagine that this is a CCP. So you and me can't really go and transact with the CCP because for that you require membership of the CCP. So most leading banks and financial institutions have their membership with the CCP. So imagine there is some CCP and there are, let's say, A, B, C, and D. Let's say we just take four members for now. Generally, the number of members is always high, but let's say there are four members to this particular CCP. So that way, in case we want to use the services of the CCP, we can go via one of these members. So either A, B, C, or D. And each of these members are going to have to do some kind of margining transactions with the CCP. So is everyone familiar with the idea of margining? So was this covered in your futures class? Initial and variation margins, etc. So IM, VM, was this covered? Initial variation and I mean the concept of margin calls, etc. So was it covered already? Okay. So initial margin basically implies that this is the kind of margin which the CCP is going to expect before it will allow any kind of transactions to go through them. So now members they are going to expect their counterparties. So now member A, they are going to have counterparties one, two, three, and so on. So different parties who want to use the services of CCP, they're doing it via member A. So member A is going to ask each of these counterparties for an initial margin. So initial margin is placed. Now without that, the CCPs will not allow any kind of transactions to happen. Next is a variation margin. Now variation margin is required because there is always a daily MTMA. because that's what we call as clearing of transactions, isn't it? So on a daily basis, there will be a daily MTM of transaction which a CCP does. And depending on how the MTM movement has happened, it is going to demand a variation margin, or it is going to demand additional funds to be placed by members. And when I say placed by members, finally it is being, now members are also going to ask their respective counterparties to put in more capital for the variation margin. So IM and VM are the two main, or the two starting points which are used by CCPs whenever they have to take care or manage any kind of credit defaults. Then there is a default fund contribution, something which every member has to do. So members A, B, C, and D have to make a default fund contribution to a CCP. In addition, members are also required to are required to purchase equity. So that is, they become the equity holders within the CCP. The idea is to have a lot of involvement from these clearing members, because the thing is, members are the people whom the CCP interacts with, and they want members to be an integral part of the system. So whenever a member is pledging a certain equity, then naturally they know that fine, I mean, they are responsible for the overall smooth functioning, and they'll behave more responsibly. So these are four popular layers which a CCP uses. So if a default is to happen, so imagine that there is a default, then the uh, first layer which is going to absorb the default will be the initial margin. So now imagine that initial margin is not sufficient to absorb the level of default. Then the variation margin will be consumed. Now imagine the default size is even bigger. Variation margin can't be is not sufficient to meet. Then the default fund contribution of a member, now that is the defaulting member, will be consumed. Again, if this doesn't happen, then maybe the member's equity can be tapped. Now, again, members' equity tapping happens to be the last option, because every member will try and resolve these kind of things before it reaches to this level. Because if members' equity gets consumed, then they lose everything which they have pledged to the CCP. So generally, in case of default, what a CCP does is it tries to auction off the transaction which is defaulting. So let's say there is a certain trade X which has defaulted. Then that defaulting trade will be auctioned off to the remaining members of the CCP. Now, if a certain member is willing to bid for that particular transaction, then yes, they become the counterparty to the trade, and that trade is transferred to their books. But if not, if the members are unable to decide on the auctioning bid, that is, if the members don't agree to take any position, then the CCP is going to divide the credit loss amongst the credit members. This is also what you call as a loss mutualization. Now, why we call it a loss mutualization? Mutualization. Just write the word fully because this is like a new term. Now, loss mutualization is generally not preferred by members because that results in each of them taking a hit. So, whenever the auctioning process falls, then the CCPs are going to go the loss mutualization route. So, whatever is the credit loss which a trade is exposing them to, that loss will be divided amongst all of the clearing members. So, that loss will be distributed between A, B, C, and D. Something which members will already always try to avoid, because no one wants to unnecessarily lose money because some other member has defaulted. But again, this is another measure by which a CCP ensures that the clearing and settlement happens smoothly. And it's important for CCPs to keep going, because if they default, then that is going to result in a loss of market confidence. So we want market members to be confident to the usage of CCP, because only if the market members are confident will they want to use the service of the CCP. And that is something which is important from CCP's business point of view as well. They want to have more and more volume of transactions on them, which they're clearing and settling. So honestly, CCPs are not really eliminating the risk, but they're trying to divide the risk amongst its members. So because finally, risk is something which you cannot completely diversify away. Now, you may diversify away, but you cannot eliminate that. You'll have to redistribute it in some way or the other. And CCPs are one of the effective ways in which you can distribute the risk amongst members, so that the overall systemic risk gets managed to a certain extent. So this is a general idea behind how a CCP functions. just switch back. Pending. Uh, not- so let's open up presentation. Okay, so should we do this? Should now I want to start with option trading strategies, something which has to be covered. So maybe, do you want to take a break for 5 minutes now, and then we can do a continuous thing for the next 1 hour 15 minutes. So that way we'll try and complete a few popular strategies today. So rather than breaking in between, can we take a break now and then we begin so that we can do it uninterrupted? So should we break for 5 minutes now?
Yes, sir, break.
All right, and then we'll continue until the end so that we'll try and cover the strategies. So let's see, I mean, how many we can cover today.
Okay.
All right. Okay, yeah. Can we resume? Is everyone back? Okay. So we'll discuss a few trading strategies now, which are pretty liquid and pretty popular amongst market participants. So, so when you say you're doing an option strategy, that basically implies you're trying to use a variety of options in order to have a certain payoff. So for every strategy, the approach will be we'll understand the strategy, we'll understand the payoffs for that, and also the reasoning behind why a certain strategy is done. So that way you know why exactly some activity is done by a certain trader. So we'll begin with the first one, a bull spread strategy. So for each of these, we are going to just ignore the transaction cost for now, because that way your payoff conditions will remain very, very easy, because finally we are interested in knowing what the payoff is. Now, final profit and loss is going to require calculation of any kind of brokerages and transaction fees, etc. That is something which you ignore for now, because we are more interested on the payoff side of things. Now, when we say a bull spread strategy, that involves two options. So let me draw the strategy first. So I'll take two strikes, K1 and K2. So two strike levels which I would want to use in my analysis, and I'll be using two options. So let me just draw this and I'll tell you what I've done. So this is a long call at K1, short call at K2. So I have taken two options with strike prices K1 and K2. They are on the same underlying stock. They have the same time to expiry. So everything else is remaining the same. Only thing is their strike prices are different. So let's understand the payoff first. We'll try and derive the payoff for three regions. So I'll draw these regions below, and then we'll see the rationale behind this strategy. So I'm purchasing one option and I'm selling the other. So if I have to draw the payoff diagram, or maybe payoff diagram is here, if I have to write the payoff equations. So I can have three regions here, isn't it? So if I just draw a dotted line here, this one and this one, just to relate the diagram with the below table. So we have this now again we'll take European options to keep things simple. So ST being less than K1, ST being between K1 and K2, and ST being greater than K2. So the financial economics class was something like this covered for you, because for IB guys this is something new, but for you guys, was this covered in any of your previous subjects?
Yes, sir, it was.
Okay, okay. So maybe for you guys it will. So how many strategies did you guys cover there?
So bull spread, strip, straps, triangle, straddle.
Okay, okay. And maybe a butterfly as well, is it?
Sir, I really don't know. I know them from
I
outside.
think we did surface butterfly a little more.
Okay, okay. All right. So for you guys, I think this will be a bit of a revision, but for IB class, this is something new. So we'll quickly run through this. I think an hour should be good enough for covering a few popular ones. So I'll just write the two options here. So one is my long call at K1, and I have a short call at K2. Now, Here I'm going to use the payoff condition for a call, which we have used in the past as well. So we have C equal to max of st minus k or 0. So this is the condition which I need to apply for all of the three scenarios, because I want to fill up these blanks so that I know what the payoff conditions are. So for the FE class, would someone like to tell me what would come in the first row for all the three regions by using the payoff condition? Since you guys have discussed this in the past, you may be familiar with this. So would anyone want to try? Or maybe row 1. Then maybe we can do the row 2. So all you have to do is you simply take this payoff condition and apply it for the three regions. So you can just keep this as st minus ki. So it will be k1, k2. And then you can just tell me what the payoff conditions would look like. Okay, so anyone from IB class, would you like to give it a go? So you focus only on this equation and try to apply this equation for each of the three boxes here. So once this is clear, then the second line is easy because they are similar. Okay. So when st is less than k1, now I'm focusing only on the first row. That is a long call at k1. So for st less than k1, can I expect a payoff here? Will I get something? So try to plug that into this and see. So if st is less than k1, do I get something or do I not get anything?
Nothing.
Correct. Absolutely. This will be 0 because I have a floor at 0, right? It's max of st minus k or 0. Now st is less than k. So if st is less than k, I have a max of a negative quantity and a 0. So that's why it will be 0. Now somewhere in between, can I write this as st minus k1? Would this be okay? And for the next, can I write it as st minus k2? Would this be correct as well? Or is something
So the third one is wrong. You've mentioned before in FE.
Okay. So I think this is something which we had covered at that time as well, is it? In the FE thing?
Yes, sir.
Oh, okay. Yes. I think I had taken a couple of sessions. I think we might have covered the strategies there. Okay, good. So request the FE class to hold on. So for the IB batch, so I'll give you a hint. Now this last section, or maybe this last equation, st minus k2, do you think this is right or wrong? So we are talking of an option which has been struck at k1. So would this be correct, or do you want me to change this bracketed term? Okay, so this will change because I'll just change the delete the brackets. It will be confusing. So this will be st minus k1 only, because finally we are talking of an option which has been struck at k1, right? We are not worried about any other strike prices. So it's only st minus k1. So whichever option you're looking at, always focus on what your strike price is. So if whatever the strike price is, your payoff condition will be dependent on that. Now for a short call position, again, I use the same condition but with a negative sign here because I've sold the option. So it's like a liability for me. Again, st less than k1, this will remain 0. Again, this will remain 0 as well, and this will be minus of st minus k2. So I can just write it as k2 minus st as well. Now these are my individual payoffs. I can also write a total payoff if I want. So I'll just write the total payoff here. There's no space, but let me just write the total of the three regions. This will be 0. This will be st minus k1, and st minus k1. This st's will cancel, so it will be k2 minus k1. So any questions for anyone? So FE class is familiar with this, but for the IB students, any questions on why we have written it this way or how exactly did we come to these equations, etc.? Okay. So generally, a bull spread strategy is, or maybe whenever I feel that the market is going to move in one direction, that is, it is going to move in the upward direction, I may want to go in via the bull spread strategy. But if I'm so optimistic that the market is only going to rise, then shouldn't I only purchase an option at K1? Why should I do anything about the option at K2? Do I really require this? So is the K2 thing required or is K1 good enough for me? What do you feel? Because anyways, if the market drops, I'm going to lose money on this. But when I say lose money, I mean mainly loss of premium which I have here. But if I'm pretty confident that the market is only going to rise, then shouldn't I be uh, better off by only transacting something at K1? Why should I really worry about K2? Anyways, I'm selling something at K2, right? So why would I want to do that? So I'll give you a hint. Think from a portfolio profitability perspective or your P&L perspective. Because finally, whenever you talk of a P&L or profitability for a portfolio, you need to take into consideration the option premiums which are used as well. Now, whenever I'm purchasing an option from somewhere, I am actually making a premium payment. So it's a cash outflow for me, and that's like a outflow which happens at point zero when I'm purchasing the option. Now, if I only keep on purchasing options, that basically implies that I am just doing cash outflows. That is, finally, when I calculate my portfolio profitability, my overall portfolio profits are going to come down by that much quantum because I've already made an expense. That is, I've already done a cash outflow at the start of the contract, and whatever payoff I get to know my net P&L, that premium has to be deducted. Now, in order to minimize the amount of premium outgo, I'm going to transact the second option as well because this will result in a payment of a premium, let's say minus C1. Whereas the second option is going to result in a premium inflow, let's say plus C2. Now, my idea is my net premium outflow is something which I want to bring down. Now, if I just transact something at K1, I don't really bother about K2, then I will only do an outflow of minus C1. But in order to rationalize my premium outflows, I would like to also sell an option at K2 so that I get an inflow of premium which is plus C2. And that way, the net premium outflow which is happening, that will come down for me. And that is the reason why I do something at K2 as well. I don't just purchase the option at K1. So does this sound okay? Any questions so far? Okay. All right. So this was the bull spread strategy. So once you note this down, let me know. Then I'll erase the board and I'll draw the next strategy. So I think one, roughly 4 or 5 strategies more, I think. And we can follow a similar approach. So, FE guys, since we had covered strategies in the past, were you able to answer the short straddle question?
So the V type payoff diagram, right?
Correct. But
Inverted V.
did you inverted V? Correct. Good. So everyone in FE was able to answer that question, is it?
So I cannot say for everyone.
Of course, yeah. Okay. All right. So this was the bull spread strategy. So can I erase the board? Can I go to the next strategy? we do a bear spread now. So again, a similar approach, we are going to take two strikes, K1 and K2, and we are going to purchase a put and we are going to sell a put. So FE guys, do you recollect how a bear spread strategy could be done via puts? So we are going to purchase a put and we are going to sell a put. So this is a long put at A2 and short put A1. All right. Again, we can plot the simple payoff diagram here as well, something which we did for the earlier strategy. Again, just three sections. Now, having an idea of these payoff diagrams is always helpful because many a times it can so happen that you may be working on a certain difficult looking strategy, but many a times that payoff of the strategy can be replicated using something which is simpler. So using these liquid strategies. So that is generally what traders will also try to do. So even if you are working on a certain difficult product, you'll try and reduce that product into something which is more simpler to understand, or something which is closer to the vanilla variety. And that, because honestly what you're trying to do is whatever is the payoff of the complex structure, you're trying to replicate that payoff for a certain or using a certain vanilla structure. So that's all that you're trying to do. So having a good idea of how a payoff diagram looks, that gives sudden visibility. Even if you are looking at a difficult structure, it makes things easy for you to understand. That's why having an idea of this is useful. So again, the three regions. Guys, just give me a minute. I'll be back. Yeah, sorry guys for the interruption. Now again, uh, writing it for the two options. So we have a long put at K2 and a short put. So maybe I can write a short put at K1. And second is the long put at K2. So now here I have to simply change my payoff condition. So earlier we had the call condition, I can use the put condition. So we have a max of K minus ST or 0. So now, would someone like to help fill in the first row? So what would happen for a short put at K1? Would anyone like to try?
0. Oh, sorry. Premium is the negative, so it will be negative payoff basically.
Correct. Very good. Yes. The next one will be
0.
okay.
And then the unlimited profit, like strike price minus option.
No, but again, I'm talking of a put only. So will I get something here?
It will be 0 only, sir.
Correct. Very good. because finally, I mean, I'm using the same payoff condition again, right? So now ST being greater than K is going to make this quantity negative. So it will be max of a negative number or zero. So that's why I get a zero. So for the IB class, were you able to understand why I have written it this way, or why Mir and why Mir has helped me write it this way? Anyone? Uh, so any questions on why it is this?
Understood, sir.
Okay, okay, great. All right. So next is the long put. So would someone like to try the long put bit as well? So can I write a K1 minus ST here?
Sir,
And
should it not be K2 minus ST?
very good. Correct. And for the next regions, will I get something?
K2 minus ST and 0.
Very good. So again, derivative written K1 there because our option has been stuck at K2. So, but good, you caught it. So thank you for that. Uh, so again, the idea is to just use the payoff condition recursively, and the rationale would remain the same here. So if I feel that the market is going to drop, I may want to go in for a bear spread bit. Now that way again, why I'm trading two options, the idea is the same. I'm trying to reduce my premium outflow, because whenever you look from a portfolio profitability, because honestly, when you look at any trading desk's performance, it is not simply governed by the kind of payoffs which they are able to generate. It is finally governed by the P&L impact which those trading activities are having. And P&L impact is something which is going to take into consideration all of your costs or trading costs which are there. And premium happens to be one of the most important components of the trading cost. So you should always try to minimize that so as to enhance the profitability. So that's why we transact two options here again, one at K1 and the other at K2. Okay. Now there is another strategy which we call as a butterfly strategy. So butterfly is something which involves a few more options. So up till now we have taken just two options. Now here there will be simply more number of options. So we can do that as well, which we call as a butterfly spread. So what that is and how that is done, we'll see. So in butterfly, we'll have three levels. One is K1, another is K2, and the third is K3. So here there are going to be, we'll be using call options here. So we have a call which is purchased at K1, call which is purchased at K3, and two calls which are sold at K2. Just write what we have done here. So this is a long call at K1. This is a long call at K3 and short or two short calls at K2. So again, let's plot the payoff chart first, or the payoff diagram first. Not the payoff diagram. Diagram is already there, the payoff equations. My apologies. And generally we keep K2 as the average of K1 and K3. So that is by far the most popular way of figuring out K2. So we generally say K2 is the average of K1 and K3. So now since we have three strikes, we'll have four regions. Now we have ST being less than K1, ST being greater than K1 and less than K2. ST being greater than K2 but less than K3, and ST being greater than K. Okay. And I'll write the three options here. So we have a. I just write it in small letters so that the space is sufficient. So long call at K1. So this is K1. Long call K3. Two short calls at K2. A line separating these. So now, anyone from the IB class, would you like to try to fill up maybe the first row? So a long call at K1, would you like to give it a go? So use the same equation. Now, since you guys are looking at this for the first time, let me just rewrite the equation for you. So it will be max of S minus K or 0. So can you try to use this equation and help me fill up row number 1? So FE class, I request you to hold on because you guys know this. But for the IB class, would you want to quickly attempt this? Anyone? So you can at least give it a try. Even if it goes wrong, it doesn't matter. Anyone? Okay. So would someone from the FE class would like to give it a go? So a quick revision for you guys again. Anyone would like to fill up row number 1? Right. So this will be, since it's a long call, this will be 0. ST minus K1, ST minus K1, ST minus K1. So again, point to note is we'll stick to K1. We will not switch the Ks because we are looking at an option which has been struck at K1. Now, if I want to fill up the long call at K3, then again, I'm using the same equation for the call option once again. This will be 0, 0, 0, ST minus K3. And two short calls at K2. So the first thing will remain 0. Second will be 0 as well. Third will be minus 2 of ST minus K2. And again, minus 2 of ST minus K2. So if I solve these together, so I mean, if I simply substitute K2 as an average of K1 and K3, and I convert them in the forms of K1 and K3. So if I get rid of K2 and if I solve this, then I get a net result. I'll write the net result directly. So you get a 0 and a 0 here, and you get a ST minus K1, and you have a K3 minus. So if you see for the butterfly strategy, what happens is as long as you're staying within the two bounds of K1 and K3, you get a certain positive payoff. And the moment you move away from those two bounds, and the moment you breach K1 and K3, you reach a payoff of 0. So, so this is how you look at a butterfly spread. If you're confident that the underlying is going to remain between two barriers, which K1 and K3, the barrier levels, I won't exactly call it as a barrier level because it can be confusing because barrier options are separate. So maybe I'll call it as a threshold. So if you believe that at maturity your ST is going to remain between two thresholds, K1 and K3, then this can be a great strategy because it will definitely generate a positive payoff for you. And if you're wrong, it is going to generate a 0 payoff. So that will result in a certain amount of premium outflow which will be lost. Of course, if you're lucky and if you're able to match the premiums exactly, then nothing like it. But it will naturally be difficult because you're taking three different strike prices, and the demand for options at different strike prices will be different. So that way, exactly matching the premium outgo will not be possible, but you try and minimize the premium outgo as much as possible. So any questions, either for the FE or the IB class? Okay. So we do one strategy which we call as a straddle. So something which was there on the examination. So a straddle strategy basically involves one single strike price. So now I'll be mixing up calls and put options. Now up till now, if you see, we haven't mixed call and put varieties. We have kept them separate. But now we are going to combine them together. So we'll have one single strike, and let's say I want to purchase options on this. So I have a long call at K. Now I don't need a K1 and K2, right? I just have one single K. And this is a long put at K. Now here the payoff diagram is also easy, and the payoff equations are also easy because it's just one single cutoff which you're trying to analyze. So we have ST less than K, ST greater than K, a call, and the put. Now all of these are stuck at K1, so I haven't written it at K1 or anything like that. Now payoff conditions are easy. I just use the same condition of ST minus K and K minus ST respectively. So ST minus K, now for a call, this will be 0, but this becomes ST minus K. And for a put, this will be K minus ST, and this will be 0. Again, using the same conditions or the payoff equations for a call and put. So now, would anyone like to try what could be the rationale behind this strategy? When do I use a straddle? So when would a trader be comfortable or confident to use a straddle strategy?
I might be wrong, but when he's not expecting a lot of fluctuations in the prices.
So think from a long straddles perspective. Would you expect fluctuations? So like the strategy which we are currently, this is like a long straddle because we have purchased both the options.
Mm-hmm.
So would you want to modify your response a bit? So would you still want to remain close to K, or would it be better off to move away from K?
Oh yes, so further away.
Correct, correct. Good. Uh, so is so is it clear to everyone why I say that that you should move away from K? And does anyone have any questions as to why that large movement from K is expected or required? So what will happen that if I am, so let's say ST ends up to be somewhere here. So imagine that finally at expiry, I am at here. So this is my ST. So compare this ST. So let's call this as ST, and maybe we'll have another level, let's say here. Let's call it as ST dash. So so again, my idea is ST dash is something which we should expect when we are entering to such strategy rather than ST. Because the reason is this is a very expensive strategy. Now, why I say expensive strategy? Because you're purchasing two options. And when you're purchasing two options, there is a heavy premium outflow which you're doing. Now, that way you're confident on one particular level. So you know that that level K, which you call as a strike price, is something which is pretty significant. But only thing is, you as a trader, maybe you're uncertain as to the way in which the market is going to go, whether it will move below K or whether it will move above K. That is something which you're not very sure about. So that's why you have transacted both call and put. But your expectation here is the movement needs to be large or it has to be significant, something like ST dashed. Now, only when the movement becomes like a ST dashed will your strategy earn a significant enough payoff. Because the idea is whenever I calculate the portfolio profitability, now that profitability will be compared against how much payoff my strategy is generating. And this payoff needs to be large enough because my premium outflow is so heavy because I've purchased two options. So that premium has to be made up. Also, at the same time, after that, the strategy should be able to generate a positive payoff for me. So for a straddle strategy to work, trader should be confident that there should be a large swing in the underlying stock price. Now, in which direction, that is a different question. But there has to be a long swing. It cannot end up somewhere like ST, because if it ends somewhere close to ST, which is very, very near K, then yes, your call option will give you a payoff, but that will be a very small payoff. That payoff will be barely enough to recover the premium outflow which has happened. So on a net basis, this strategy will generate a negative payoff if we end up at ST. But that may not be the case if we reach an ST dash, which is significantly away from K. Now, ST dash can be here or ST dash can be here as well. Be it on either sides, your at least one option should fire and it should be able to generate a significant enough payoff for you. Only then will that trader be able to generate a profit on this idea. So is this okay? Now, the question was of short straddle. So, in a short straddle, so as Stuti had mentioned some time back, the answer which she had given, that was for the short straddle one. So, for a short straddle, you are exactly on the opposite side. So, you still have a K here, but then you have sold two options. So, you have sold a call and you have sold a put. So as she had rightly said that we want to remain close to K. So that is valid here. Now, if we are close to K, that it's always good for us, right? Because we have sold the options. So when I sell the option, I receive a premium. So I am happy with the premium and I would like to keep that premium intact. That is, I don't want the trader to exercise the option. So a trader, so even if there is a minor movement around K. So if it happens to be something like ST here, then I'll be very happy because yes, that put is giving a certain payoff, but it's very small. The kind of premium which I've received is significantly large. So this was a short straddle question which was there on the exam. Uh, Now, a short straddle implies that we have sold both of these options. And in that idea, or whenever we are doing a short straddle, we do not, or we hope that there is not too much of a swing in the underlying price away from K in order to protect the premiums which we have received. So, does this sound okay? So, for the IB class as well, because you guys are seeing this strategy for the first time, any questions on this? Okay. So, this was straddle. We can do a triangle as well. Again, I'm going to mix up two options, con and put. Only thing is for a strangle, I'm going to look at two different strikes. So again, I have a K1 and K2 in picture once again. So I do a long call at K2. I do a long put at K1. Let's draw the payoff equations. Long call at K2. I'll just write the three regions here. ST, less than K1, ST in between, and greater. Let me just fill up the chart quickly. Zero, ST minus this way, K1 minus ST, 0. Okay. Again, a strategy which is similar in ideas to the earlier one, the straddle one. Only thing is, rather than focusing on one single level of strike, we are focusing on two levels, K1 and K2. So maybe the trader has an analysis that these two levels are pretty significant, so they would want to go in either for a K1 or a K2. So what they do is they purchase options in both of these places, and again, here you expect the stock to move beyond these boundaries. So now, if you remain between K1 and K2 at expiry, then this strategy is not going to generate any payoffs. Now, in order for this strategy to give a certain payoff, it has to move in either direction. That is, the two thresholds which are given by K1 and K2, they have to be breached. So again, a slightly expensive strategy because we are purchasing two options. So we expect that there has to be a movement, and again, a significant movement either in beyond K1 or beyond K2. Now that will ensure that the premium outflow, which we have done for two options, that gets made up, and that is something which is going to generate required profitability which the trader demands. So this is what we call as a strangle strategy. Now, there are multiple other strategies which get used as well, but these are the ones which we'll commonly observe being used by market participants. So that's why we have covered them here. And many a times, your advanced options which you study, you can try and maybe break that strategy into simpler ones, because especially even from your modeling perspective, that becomes easy. Because if you have a very difficult looking strategy, and if that can be broken down into something which is simpler, then even building your pricing models becomes pretty easy, because vanilla option models you already have. So that way, if you can simply try and uh, break up a larger strategy into something which is simple, that is always preferable. So that is something which you will observe in a common marketplace as well. Also, whenever you look at term sheets for products, now term sheets of products will also have these kind of payoff diagrams which are always given. So if you look at any options term sheet, so when you join your respective organizations, if you are a part of either a bank risk, or maybe bank treasury, or consulting, or the audit practice, now at that time you will have access to term sheets which are done by banks and financial institutions. And in that term sheet, you'll always find a section. So if you're looking at an option trade, so that term sheet will have a certain section which talks about the option strategy. Now the idea is why the market does it, because that way investors who may not be savvy enough as to what that strategy does, they will get a complete idea as to what will happen if the stock price moves in a certain way. Now, that is required because not every investor is familiar with options. Now, they may want to trade options, but they may be new to the market. So, in order to give them additional clarity as to what to expect from a certain transaction, this is something which we include as a part of the term sheet. This is also what we call as a scenario analysis. That is, we are giving a complete picture to the investor that yes, you are entering into a transaction, but this is what you can expect if any of these scenarios are to materialize. So we can imagine this is scenario one, scenario two, and scenario three. So if either of these scenarios materialize, this is what you can expect. So that way, the investor also understands that fine, and this is what they have got into, and they have clarity on things. So, so that's why having an idea of these things is useful. Many a times when you talk to clients, they may also request you to maybe explain this via a diagram, because if you simply show them a payoff condition, say a payoff equation, they'll say, "Fine, this is an algebraic equation, but we have never worked on options. So can you help us understand what that is?" So that way, if you're trying to explain this to your clients, this is also something which they will find very useful, because something which you can show pictorially, that becomes more appealing. So that is another application where such payoff diagrams get frequently used. Okay, let's go through this strategy bit. The important ones we have covered. Okay. All right. So this was something on basics of trading strategies. Actually, so now we know what strategies look like. Um, Now we still have like 15 minutes, right? So let me just open up and see if we can do something new. So I think we have to discuss something on walls miles. So option walls is something which we haven't discussed yet. So let me just see if we can do a part of that today. Just give me a second. Maybe the basics we can cover now. So let me just start the presentation. So guys, we still have about 15-20 minutes. So should we do some basic discussion on volatilities, and so that the next time we can complete option wall smiles. So are you game for that? Can we discuss at least the basics today, or is it kind of heavy now?
Sorry, it's kind of heavy. We have another class at 2:30.
Oh, okay, okay, all right, all right. So maybe we'll not start something new, but maybe I think this could be a good time to maybe generally give you an idea of your next assignment. So I think that's called as a periodical, right? So next periodical, I'm thinking it will be something on modeling, because we have discussed some bit of basic VBA modeling. So I'll also talk to Shrikant sir today. So that way, it's just 9th of April today. So I think your next periodical is in 1 month's time. So maybe what I could request you guys is do some brush up on VBA programming. Now, I'm not insisting Python because many of you are not using Python much, you're using R. But VBA is something which sits inside Excel. So I would say that brush up things on VBA. So that way you get time to prepare for this programming, so that when you get that project to be done as a periodical, you'll already be ready with the ideas or the basic building blocks around VBA. So good resource, which I had used long time back, is Excel VBA for Dummies. I'll check out if I have the file with me, but it has been a while since I've had used that. But if not, I think it's freely downloadable. So Excel VBA for Dummies. So this is a decent book to start. And again, we'll only keep those things which you have discussed in class. So that way you know the subject matter already, and you can convert that into a working model. But for that, maybe if you can do some brush up on what are the data types within a VBA, or also what is looping inside a VBA, also what are conditional statements, maybe what is a user defined function, etc. So simpler ones we have done up till now, but maybe this is something which can be interesting. So I would request that maybe start brushing up on these things. I'll also drop an email on the group so that everyone knows that they have to prepare for this, and I'll update Srikant that this is the plan for the next periodical. So what the assignment will be, I'll tell you in a couple of weeks. But until then, you can continue your preparation, because I don't want to keep I don't want to keep this a surprise. Now, I mean, I can tell you that tomorrow is your programming assignment. Do a VBA thing. That will be unfair. So that's why I'm telling you in advance. Uh, and at least browse through basic things on VBA. If you do get a chance, you can do some simple hands-on stuff yourself as well. So that way you'll get more confidence as to the way in which VBA functions, and that way building a model will be easy. Again, we'll be sticking to simpler things, nothing which is discussed beyond our syllabus. Uh, I'll only give you those tasks which can be easily handled inside a VBA, not something which will require advanced analytics. Because for advanced analytics, you always have scripting, right? But the simpler ones you can definitely do through Excel VBA, and this will be a good opportunity for you guys to pick up VBA as well, because that is something which you'll require in your respective jobs. Because most companies still prefer to use Excel. So at that time, if you are comfortable with VBA, then you can combine your Excel along with the VBA part, and that will give you more confidence to work on projects. So, so I mean, this is just one reference. This VBA for Dummies. There are many other references which you'll get online. So pick any one which you like, and you can pursue that. But begin your preparation now so that you have time until the next periodical, and then we can basically have that modeling exercise as a part of your periodical submission.
So the modeling will be for what, like VAR or?
So let me think of that. So let me think of something which is manageable in VBA. And again, I'll give you what the task is. I'll give you the data set as well. So that way, it will be easy for me to check as well. So that once we have a uniform data set, it will be easy.
Sir, and just one more thing. Sir, can you please recommend any reading material or learning material for VBA? Because most of us are not familiar with VBA like we are with R or Python. So
Correct. So Excel VBA for Dummies is something which is a good resource. So now again, is everyone comfortable with Python? Now my thought was that you guys are using R programming more, but do you guys know Python? If that is the case, we can do a Python bit as well. So in your syllabus, what is covered? Do you have Python or R, or only one of that is covered?
So both were covered, but we are more familiar with Python, I guess.
Okay, okay. And that's for both the classes, is it? IB and FE?
yes, sir. So it wasn't taught explicitly as such, R or Python,
Okay.
but we are aware of say time series and other modeling things on R and Python.
Okay, excellent. Then we can do this. Then let's drop VBA. If that is the case, because VBA will be a new tool for you to learn. So maybe let's drop VBA. We can do a Python assignment. So we can use Python as the main tool. Now again, you can brush up a few things on Python, so you'll have some time to brush up on the basic ideas, and what the project will be, that is something which I'll tell you in the due course. So that can be
It will
like,
be individual or group based.
again, I'll give that a thought as well. I think mainly group based, because it will be easier that way. It will be easier for me to correct basically. But again, let me have a word with Shrikant as well. And if this is fine, so maybe let me come back to you by in our next class. So this is my idea. If your institute concurs, then I have no problem. So we can go ahead with this. Again, I'll drop an email as well once I have a word with Shrikant sir, so that everyone knows that they have to brush up things on Python and they're ready for the assignment. Because there's no point in keeping that as a surprise. It's always good to prepare first and then take the exam. I can just quickly take the attendance. We are just a few of us, so maybe I can just mark your attendance directly rather than taking the entire thing. So can I get names of people from FE? I'll mark you directly. So a few of you I am seeing. So so Mihir is there. So Mihir is there. Shruti is there. Rajaditya is there. Rahul Ghosh is there.
Sir, Gaurav Kadam.
Gaurav Kadam. Okay. Yeah, Gaurav Kadam is there.
Jaydeep sir.
Jaideep. Yeah.
Say Manshi.
Yeah. So
Sharanya.
Jaideep
Sir,
is there.
Muskan Gar.
Okay, so Jaideep is there, Sharanya is there, Muskan is
Sir,
there.
Ruma.
Okay, Roma Kishri,
Sir, Ayush.
Ayush is there as well. I think Ayush is right at the top. So Ayush Bhushal, right?
Sir Pratik.
Yes, sir.
Yeah. Okay, Ayush is present. Pratik is present as well. Okay, so I'll just call out the names. Let me know if I missed someone. So Ayush Bhushal, Gaurav Kadam, Jaideep. I think Dipansha is also present, is it?
Sir, Manshi.
Oh yeah, Himanshi, yes, I've marked you. Yes. Uh, so uh, yeah, so Ayush, Gaurav Kadam, Himanshi, Jaideep. Then we have sorry, Mihir. We have Muskan Garg. We have
Sir
Pratik.
Tejas.
Sorry.
Sir Tejas from FE.
Okay, Tejas, I've marked you. Tejas
So
acquired.
did you mark Stuti?
Yes, yes.
Thank
I've
you.
marked Stuti. I've marked Mihir as well. Muskan. I've marked Rajaditya is present. Ruma is present. Sharanya is present. Yeah. All right.
Sir Rahul Ghosh.
Yes,
Sir
Rahul Ghosh.
Pratik.
Yes, you're marked as well. Yes.
Okay.
Pratik is also present. Yes.
Thank you, sir.
All right. Okay. Yeah. So I just take the attendance for IB as well. So IB, I think. Let's go through the list quickly. IB, we have Sawan Hake is present. Himanshi is present. Simran is present. Vidushi Rana is present as well, is it?
Yes, sir, present.
Okay. Yeah. So from IB, we have Sawan, we have Himanshi, we have Simran, and we have Vidushi. Anyone else whom I have missed from IB?
No, sir.
Okay. All right. Okay, great. So thank you so much. Thanks for joining in, and I'll see you guys on Monday, and we'll discuss a few things on volatility. So we'll try and complete Wall Smiles on Monday.
Thank you, sir.
Thank you. Thank you. Have a good
Thank
weekend
you.
ahead.